Hey, Blockhead traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, August 16th, 2023, and this is Blockhead Traders Weekly. In this week's episode, I'm joined by fellow Blockhead trader Viper XL 007, and we are going to take a look at bonds and treasury products, which are kind of notes and bills and boring fixed income things, and wonder where does all this really fit in your current portfolio? How can you use it? It's been an area that I've kind of been a little bit intrigued and interested in with all the talk of interest rates and this, that, and the other thing. And so I've been spending a little bit of time digging in, and I'm going to share what I've learned with you guys. But before we hop to that content, I want to give a shout out to our Discord, link in the description below. Hop in there. You can say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're interested in. Love to hear what type of content you want to hear on the show. You will also find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Lastly, you can pick this up in an audio-only format wherever you get your podcasts. And if you look for it there and you can't find us, let us know and we will get it there. But let's hop to the content this week. Viper, I want to talk about fixed income and bonds, treasury notes, bills. It's really been in the news, not just as of lately, but I'd say the last year, right? Year plus, when the Fed started raising these interest rates, and there's all this talk about, oh, the Fed's going to have to cut soon, or oh, the Fed's going to hike again. And there's all the talk, they kind of mention, oh, the Treasury, sold more bills out, or there's quantitative easing, quantitative tightening, all this stuff around there. And the other place you hear it is, financial planners and stuff like that talking about, well, the traditional 40-60 bond portfolio stock split and this, that, and the other thing. And I said, you know what? I really don't know much about these treasury products and what's going on. So I kind of decided to dig in a little bit to see what type of thing I can find. And I'm going to be honest, I'm actually kind of excited to talk about it, because I don't know if this is just a thing where you got a new shiny toy that you haven't really ever seen before or kind of understood, and it's just cool to have, or how long I'll stay interested in this. But I've been dipping my toe on a couple of different purchases here on this product. I've been kind of reading about them to try to figure out how do they work, and so I'm pretty excited about it. I don't know if you know anything about treasury bills, notes, or bonds, or fixed income, or anything like that. But have you ever dabbled or know much or read much about this stuff?
I could definitely say no. But I mean, it has, like so many other things on the journey of this show and in the last year and a half or so. It has come up, like you said. I've heard people talk about like T-bills and stuff like that. And especially as we came around to quantitative tightening and as rates started going up, like it started, popping up all over the place. So started looking into it along those lines, because that's how this season of financial life has gone, is exploring when something pops up, like let's dig in and see what that is. So I looked into it briefly, but it definitely wasn't, I don't want to say boring, but it wasn't something I was able to easily get a hold of fitting it into my current plan or my current prospectus or whatever. But some of that was also not knowing a ton about it and needing to get back around to it. So I guess here we are. We're back around to it.
Yes, we are. And for sure, if you think of exciting as, wow, I just bought this thing and it turned into a 10Xer or a 15Xer, yeah, that's not happening with treasuries at all, sadly. So if that's what you're looking for, move on to someone else. They probably have cool videos on Lambos or things like that. But I want to dig in a little bit here to treasuries, and I'm definitely going to preface this with, this is an introductory thing. So I'm going to kind of cover some of the basics. I am certainly intrigued by this world. I'm going to broaden that to fixed income in general. Like some areas that I want to dig into are corporate bonds, municipal bonds, just kind of other debt products and holding them and the different ratings and things like that. But this episode is going to be all about treasuries and the particular financial products that the treasuries issue themselves. And I figure what better place to start than what on earth is the treasury? Everybody hears about a treasury, and maybe, when you're in school, you're like, this is the school treasurer, or a particular function says, this is the treasurer. And so I'm like, as a kid, I'm like, the treasury, is that like the building that's got all the chests with loots of gold and stuff? And actually, I guess it wouldn't be quite chests of gold, but the treasury is really the thing that makes the world or at least the government work. So it was actually one of the very first things that the very first Congress did was kind of establish the Treasury. The very first president of the Treasury, or a guy in charge of it all, was Alexander Hamilton, who, I guess that's a popular known name now that there's a whole like musical around Hamilton. Haven't seen it myself, so I'm not really sure how closely it tracks to the Treasury itself.
Well, I mean, there is a bit of a song where he's asking Thomas Jefferson, or sorry, was it Thomas Jefferson? Oh boy. Well, he asked him, do you want me to run the treasury or the state? So, it's definitely a center theme.
Yeah. So, what is the Treasury for? And I'll say here, it's responsible for systems that run the financial infrastructure of the United States. So they're responsible for issuing payments, collecting taxes, producing coins, issuing debt. And you might say, well, what the heck? IRS is responsible for, collecting taxes. And well, the collecting part, the enforcement, right? That's the IRS. But when you submit your payment, your tax payment, you address it to the Treasury. Basically, that gets deposited into the Treasury. And if you get a refund, that refund check comes from the Treasury. So that's what I think that is all about, the collecting of the taxes, it's the actual physical receipt of the taxes, not the whole process of, enforcement and stuff like that. And the big one is issuing debt. And that's really what we're going to talk about today, because debt issuance is what these financial products that the Treasury issues. Those are your bills, your notes, your bonds. And why the heck do they do those? Well, because the government needs money, and we don't raise enough money to pay for the things the government needs to do. So basically, we got a big old credit card, and then Congress authorizes a spending limit for the Treasury. It says, oh, you're allowed to go up to $37 trillion or whatever the number is, right? And the Treasury is basically allowed then to issue debt up to that amount. So, it says, hey, here's an IOU for this. And we won't get, political in here, but fundamentally, they spend more than they take in. And so this act of issuing the debt is needed, because without it, there's not enough cash inflow to basically fund all the operations of the government. And so this debt issuance is exactly what we are going to be speaking about today. And that debt issuance comes in the terms of three types of products. Viper mentioned T-bills. So they will have things that they call bills. They will have things that they call notes, Treasury notes, and they will have things called Treasury bonds, or U.S. bonds. It's different than savings bond, but there is a U.S. bond issued by the Treasury. And in my simple brain, when I heard all these terms, I always thought they were all talking about the same thing. I'm like, oh yeah, that's just the same word for a different product. And it kind of is, but there is a little bit of a nuance that was not super amazing to learn. I thought there would be a more complex or intricate definition. It's just time-based. So if this particular debt that is issued will be paid back within 0 to 1 year, 0 weeks to 1 year, it's called a bill. Kind of makes sense, right? You get a bill from your cable company, you get a bill from your electric company, it's due pretty quickly. And so basically everything that is in that, the products range from a 4-week product, that's the smallest time that they issue, And a 52-week product is the longest time that is issued and still called a bill. The next one is a note. And basically, a notes are anything greater than a year. So 1 year is considered still a bill, but if it's greater than 1 year, but less than 20, it's called a note. And there's several different ones. There's 2-year, 5-year, 7-year, 10-year. All those different things, those are all called Treasury notes. And the very last one is a bond. And a bond is basically equal to 20 years or greater. And there's really only two bond products. There's a 20-year bond and a 30-year bond. So even though the note, it goes up to 20 years, but it doesn't include 20, bond is basically the 20 and 30-year products. So now that we got all that language and definition out of the way, you might want to say, well, where do I buy these treasuries? How can I buy them if they're always, kind of going out there? Where do I get them from? And there's really three areas in which you can purchase these treasuries. The first is you can purchase them directly from the United States Treasury. So there's a website, treasurydirect.gov, and it has all kinds of information about the products themselves. It's actually where I picked up most of what I learned about these products was on treasurydirect.gov. I figure what better place to learn about things than the actual body that is issuing them. And they have a surprisingly friendly website for really newcomers. It's not really that, financial jargon oogala boogala that you might see when somebody opens up some big trading screen and you see numbers flying through and charts and you're like, what are all these alpha, beta, delta, gamma? Like none of that. It's actually very much in plain English, very much in very user-friendly terms that you can really learn about things. Interesting thing, the smallest denomination that you can purchase treasuries from Treasury Direct is $100. That is the most affordable way to get into treasuries. You'll find the other two methods actually require a larger minimum purchase to participate. The one that I have been experimenting with is in my brokerage account. That is the other place that you can pick up these treasuries from. And in the brokerage account, it will vary from broker to broker, and most of them will have a minimum purchase. It seemed in my quick research that most of those minimum purchases were $1,000. However, there are some brokers that had minimum purchases of like $5,000 to participate in the treasuries. So depending on what you wanted to purchase, the quantity, that might influence where you go. You also can purchase from your local bank. I didn't really explore this because it seemed really old-fashioned and didn't seem very convenient at all because it looked like I was going to have to go to my bank to purchase them. So I didn't really dig into this much more than the fact that is a place that you can buy them. And those are really the three different ways. And from what I can tell in my research, once you have them, reselling them back is very easy, no matter if you had procured them from Treasury Direct or your brokerage account. For me, it just made sense to be in my brokerage account. That's, you'll see later on that it's a part of my portfolio now. And, I really like everything under that one umbrella. And the minimum of $1,000 wasn't that big of a deal breaker for me because when you're dealing with these interest rates, $100 seems kind of small, but anyway, those are the different ways to purchase. So if we come over here, I just want to show you real quickly, this is the Treasury Direct website that I'm talking about. And, they have what I consider pretty easy, auctions, about auctions. And they have this nice about how do auctions work? What are the upcoming auctions? What are the recent results? What's the historical search? You can look up savings bond, buy a bonds. What are savings bonds, cash in bonds? And really just kind of talk about all of the stuff. And it'll show you, okay, here is the next issuance date. Here is the rate of what the most recent one went for. So it's a good website to really gain all the information specifically around the treasuries and the products that they're putting out there. And purchasing from the Treasury website is also really easy. You automatically kind of create this account. You can go in there, you push buy direct because you're buying direct, and they got it all noted here. You got your bills, and they even put short-term securities of 1 year or less. Here you go. You got your notes, which is basically 2 to 10 years. Bonds, which are more than 10 years. Now, 10 years is because there is no product between 10 and 20, which is why my previous thing denoted the difference at 20. They have these things called TIPS, notes and bonds. I'm not going to get into those in this episode, but basically those are inflation protected. So the I basically is inflation, and it's a treasury and inflation protected. So, you might think, what if I buy this bond for, 30 years and it's going to return, let's say 4%, right? But what if inflation ends up being like 9%? Then you're going to lose money because you're returning less than inflation. If that's a worry that you have, then these tips are effectively a mitigation against that, because they guarantee you that they will at least match inflation there as well. So I won't get into that in this particular episode. You can look into that. It wasn't something I wanted to touch on when I was reading in. Likewise, if you go through your brokerage, mine is TD Ameritrade. We kind of come in here. There is new issues for under the bonds and CDs. There's all kinds of things in here. You can get corporate stuff, but right here they got treasury auctions. So we can click on treasury auctions. And then right here, depending on what's upcoming, you can select what you want to participate in. Here's a 4-week treasury bill that's eligible for participation. You click that, you say, how many of these things do you want? In my particular brokerage, there are packs of 1,000. So if you want one, you say 1,000, you say review order, boom, you say go. If you actually want to put that in, and it'll execute. So pretty easy to go through. It tells you right here, you don't know what the coupon rate is or what it's going to be, but you can put your order in right in your brokerage in the web. So that really covers, where can you buy these treasuries? Well, the next thing that you might have caught on in a couple of those screen grabs and kind of flipping through there is you can't just go any day that you want and purchase these things. So you have to only buy at certain windows if you want to buy them at new issue. You can buy these on the secondary market. In fact, the secondary market is incredibly liquid. I'm not going to get into the secondary market because I didn't explore that very much. But from my research, it basically says that the best price that you will get on treasuries is brand new, straight from the treasury. And so that's really the only thing that I considered when I was going through this learning. And then when these auctions happen, they really vary based on what type of debt product it is. So in general, treasurydirect.gov is going to be your best source of information because that's who actually issues it. They will have the schedule on there. They will have the important dates of when the auction is announced, when the auction happens, and when the auction settles. Generally speaking, bills, so these are the less than 1 year, they have an auction every single week. Believe most of them are on Thursday. The auction is announced on a Tuesday and then it occurs on a Thursday, but they are every single week except for the 52-week bill. The 52-week bill is only offered every 4 weeks. Interestingly, they call it every 4 weeks and not monthly. I'm guessing because some months might have like 5 weeks or something, and so they might end up having some overlap of when they are. So basically, bills actually auction every 4 weeks, or the 52-week bill is every 4 weeks. Everything else is weekly. Notes. So these are the 1 year, the 2 year, the 3 year, 5, 7, 10, all those things between the greater than 1 and less than 20. Those are pretty much monthly, every single one, except the 10 year, which is the longest note that they have. That actually is only done quarterly. Everything else is done monthly. And then which day of the month and stuff, you have to check the website. I don't remember them, but generally it's monthly. And then lastly, bonds, which are the 20 year and the 30 year. Those are quarterly. So there's only 4 of those auctions every year. And the Treasury will announce them if you want to participate in them. So we've covered the how and the when. And you're like, but what about all this interest rate that you're talking about? Or how does this auction actually work? Do I have to like log in and is this like click a button on my computer to say, I bid $5? So this is actually, in my opinion, one of the most interesting pieces of what I learned is how does this auction actually work? And the way it works is effectively a reverse auction. So it's called a Dutch auction, where they start at a high price and then they go lower. So every note that is issued has a $100 par value. And so at the end of the term, the government is going to pay you $100. And so the way the auction works is they say, okay, who wants to buy these for $100? And then I would imagine most people say, no thanks. And then effectively they work down in the price that they're offering for the particular issuance of debt. So maybe they'll be like 99.2249994. And then they'll just kind of keep going down until they get enough bidders that cover the amount of debt that they want to issue. So I put a rough example up here on this particular slide here. And so in this example, the Treasury is looking to raise $9 million in the auction. So they want to auction $9 million of debt off. They need to collect $9 million. And it's going to be a 4-week auction for a 4-week bill. And so, they might have $1 million that say at 4.49% interest. So remember, the yield is inverse to the price. So the lower the price goes, the higher the yield goes. So once they collect all these bids, what they do is they take the highest bid price. So that's the $99.8, $99.7, and they go down from the highest bid to the lowest bid for what they'll pay for it until they hit their $9 million. So in this example, everybody that bid the $1 million for a 4.49% yield, they get filled. Everybody that bid at the 2.5 million, they get filled. 2 million, they get filled. 1.5 million, they get filled. Then they hit the 3 million, and that's more than they need to cover the rest of the gap. So in this particular case, the first 2 million bids that come in at the 507, they will get issued debt. And then everybody else above that loses. They don't get any of the debt issuance. And this is the cool part, in my opinion, is even if you're the guy that bid the 4.49% yield, because the auction cleared at 5.07, because that was that's where they raised the money, that's where the cutoff is, every participant in the auction now gets the price of that bidder. So effectively, that person that put in that low bid of 4.49% yield, they will get the fill of the auction at a 5.07% rate. So now we've got the rate to understand, okay, that's what's going to get paid on this. How the heck do we get paid? How do I collect this yield? And so this is the other interesting thing, particularly around bills. Those are the short-term treasuries, less than a year. And that is, there is no interest payment in bills. So the only interest payment that you get is the discount at which you were able to purchase the bill for. So I recently participated in the 4-week Treasury auction last week, just to see how it goes. I also did the 10-year note as well. But in the 4-week bill, the auction settled at 99.59. It actually was more digits in there, but I simplified this for, let's just say it settled at 99.59. I basically paid $99.59 for a $100 par value note. So in 4 weeks, the government is going to pay me $100, but I only paid $99.59. So the way you calculate the yield on what you got there is you take the difference between those things, because effectively that is my interest payment. The discount that I was able to purchase the thing for is my interest that I'm getting, and I get it back when they pay me the par value of the bill that I was issued. And so you can basically take the par value minus the purchase price, divide it by the par value, multiply it by 360 divided by the days to maturity. So that basically just prorates the yield for, whatever the time period of the note or issuance is. So in this case, 28 days. So 360 divided by 28, you can see that the yield on that 4-week Treasury note, 4-week Treasury bill was about 5.25%. So that covers how bills pay you. Notes and bonds, they go through the same auction process, And so the way that the value that you paid for it is at a discount. But in addition to that discount, those bonds and notes will have a coupon rate. And that coupon rate is basically what gets paid out every 6 months on those. And this is where the yield can change based on the value of the bond at the time the issue pays. So for me, the original purchaser of that 10-year note that I talked about, I believe that was issued at a 3 7/8% coupon rate. So every 6 months, I will get 3 7/8% interest, well, divided by 2 because that's annual interest, paid to me on $100 par value. Now, I got that at a discount, but let's say in the market, in the secondary market, let's say, bond prices go way down, like they continue to drop. Someone else might want to buy that bond from me. I could sell it now. I would lose money because the bond price has gone down a little bit, but the yield that person is going to get will be greater because they now they paid less than I did. If it goes the other way, I am still getting my interest rate based on what I purchased it at. But if somebody else were to buy it, that yield would go down. So that is basically how you collect your yield. I haven't got any of my interest payments for my 10-year bond because it hasn't been 6 months since I bought it. 10-year note, I should say. But basically the way I read it is that basically just goes directly into my brokerage account. For your Treasury account, your Treasury Direct, it would go in there. But it just gets paid out to you. So where does all this fit in, you might ask? And where this fits in for you, I don't know. That's for you to look into to see how you might leverage it. I can tell you for me, what this is going to do is it will allow me to put my cash to work within my brokerage account when I don't have it deployed in stocks or options. This is particularly helpful for me because my main trading goal is to sell option premium. And one of the things you have to do when you sell option premium is there's a thing called buying power expansion. I won't get into it in this episode. Go back, watch other episodes. I definitely talk about it before. But I will only deploy a certain percentage of my portfolio. It's usually between 50 and at most 75% of my cash. And that's because I have to protect for drawdowns and buying power expansion in the case that something really moves against me. So that means I have 25% or more of my portfolio sitting in cash. Now, you'll notice if you've ever really had a brokerage account that most brokerages don't really pay you interest on your cash balances. They will kind of sweep your funds into an interest-bearing account, but it is very, very low interest compared to other savings products, compared to your bank savings rate. It's very low. What this allows me to do, and this is the strategy that I'm deploying in my portfolio, is I'm taking that 25% cash and I am doing what's known as a ladder into these treasuries. So I'm doing the 4-week treasuries because I don't want this to be a long-term thing. I want to basically just put my cash somewhere and I want it to be able to come back out. In an emergency, I could sell the notes and get my cash back out. It virtually is the same as cash because the value really doesn't fluctuate much. It's like rock solid steady. And then what this will do is, the first week I'll put, 5% of my cash in. Next week, I put another 5% of my cash in. Next week, I put another 5% of my cash in. Next week, another 5%. Then the next week, 5% of my cash comes back and I just stick it back in. And that's that ladder. That is every week I'm putting 5% of my cash in a treasury. And then once the 5th week comes around, the first batch comes out and I just recycle that back in. What that allows me to do is put that cash to work for me at a rate of that 4-week treasury. So right now that's over a 5% yield, where I otherwise would be getting less than probably 0.5% with my brokerage account. If anything were to happen and I need that cash as part of my brokerage or trading, I simply sell those bonds back, which largely will go for $99.50 or $99.59. So you're really not losing anything there. In my particular brokerage in TD Ameritrade, the impact to your buying power from holding a US Treasury, now it depends on the length of time, but for the 4-week 4-week bill that I have, it is a 1% hit on your buying power. So that basically means my buying power is only impacted by 1% when I bought that 4-week Treasury. And that makes sense because effectively, US Treasuries are the de facto standard in the world when it comes to stability, debt issuance, all that stuff. And so they are virtually viewed the same as cash. So the buying power impact, it makes sense to be very low because they're very low risk of getting out of kilter to the point of really disturbing things. So for a $1,000 4-week Treasury purchase, my buying power is impacted by $10. That's it. And then the last benefit of Treasuries is your interest that you earn on them, or the discount yield, however you collect that benefit from the Treasury. It actually is tax-free at the state and local level. You still owe federal income tax on it, but it is tax-free at state and local level. That is different than a savings account or a bank account or anything else like that, where you still have to pay in your 1099-INT taxes on that interest earned at the state and local level. So a little tiny bit of tax advantage here as well. Viper, that was a lot of information on treasuries, notes, bonds, bills, all those things like that. I don't know if that's anything that you didn't know before, or if there's any aspect of that where you're like, wow, that's kind of interesting. I might have to take a gander at this when it comes to things in your portfolio or your trading world.
Yeah, definitely. So it was along the lines of what I expected or what I had seen in the little bit of research that I had done around it. The thing I like the most is just playing through the scenarios, or let's even say the implications of what you're looking at there. And so specifically, there's not really a fit for my current portfolio, and that was, just due to like, I don't have a lot of cash on hand in the plays that I'm in or whatever. I have a different running strategy for my current portfolio size, which, I think I mentioned it before, but just, going through various major purchases and things like that, things were drawn back a little bit. But I'm very interested in the future, as I start to build this thing back up and I start to get back into a habit of having more cash on hand and things like that, the one image that I got that I really liked was that, like you said, holding your cash in this and then doing the ladder and that sort of thing. To me, that sounds like all the advantages of a, say, savings account, but this isn't saying it should replace savings account, so don't misconstrue that. But all the all the advantages of a savings account for that cash that's sitting there, but cutting the bank out of the equation. The bank is essentially doing very similar things with your money when it's sitting in the savings account. Savings accounts are key financial instruments, so you shouldn't, want to cut the bank out in all cases. But that was the image that I got as far as taking control of your money in a way that somebody else would anyways. So, kind of reaping some of that benefit, like you said. And I really like the ladder because, that way it buffers that 4-week period to always have some cycle. So if you get into those pinches or whatever, you're like, well, next week there's another unlock issuance or whatever. So, I think it's interesting, and I think it's good to demystify that, I think everybody's, whether you're in financial markets or not, you've heard the names, you've heard the words, and it just sounds like snooze fest. But, and if anybody's still here and still feels like that, I think it's good to just make a mental note and come back to it, because I don't know that I would have been interested when I started my journey 2 years ago or whatever. But now that I've, you know, touched volatility and had losses and, try to build a better strategy, it becomes a lot more obvious where and why this would become beneficial.
Yeah. And just to kind of touch on the whole bank thing that you brought up, I mean, this is effectively, I always kind of heard people talk about it, but never really looked in or thought about it. This is really why your bank's interest rate is a little bit less than the thing when someone says, "Well, the Fed has raised interest rates to 5.25%." And if you go look at banks, you'll see most banks are offering, maybe 3.5, 4.25, maybe. They never match the Fed rate. Well, that's because what they're doing is they're collecting your money, paying you back at that rate of 4.25. They're going to the Fed short-term window here. They're picking up these 4-week Treasury or 4-week bills, and they're earning 5.25. So they're paying you the 4.25, and then they're pocketing that 1% on that spread, and that's how they're making money. And so, I'll say that was kind of the idea. Honestly, the thing that really related to that really got me in there is back at the beginning of 22. I had this idea that I needed to do something with all this cash that I had that of my options selling, like I mentioned. And I said, you know what? I should just hold big blue chip stocks like Microsoft, Apple, things like that. And so I started selling puts at the money to get assigned the shares, and I actually had a lot of shares. And 22 is, we went down like 30% in the market. And that drawdown just beat the heck out of me because I was holding a lot of this stock thinking, oh, this will be a nice stabilizer or balance in my portfolio. Honestly, I thought about bonds and treasuries and stuff like that because people had said they're stable. And I was like, nah, that's probably boring. I'm not going to bother looking into them. And so this time around, I battled back from all of that and looking for the same thing to say, I really don't like having this chunk of cash sitting in my brokerage account, not doing anything. I always want every ounce of my money to be working for me in the background because that's how compounding things work. That's how kind of leveraging all that stuff and maximizing it in efficiency. And I'm a nerd and an engineer background, right? So I always want to be the most efficient with everything, most efficient with my capital, most efficient with this. And it just kills me having the cash sit there. But it also really was a pain in the butt to put it all in stocks and then see 33% just totally evaporate. And so, yeah, that ballast, that's one of the approaches I'm trying this time. We'll see how it works out. Maybe in another year, I'll do another video and it'll be like, what the heck was that guy thinking? But hey, that's learning for you. So that brings us to the end of this week's episode. If you hung in there with us the whole time, I hope you learned something. Like I said, I have been kind of dabbling down this journey of trading now since 2018. So it's been 5 years, and I have never been interested to look down what the heck is a bond, a note, a bill. Finally got around to it, and I'm pretty excited about what I've learned. I know I've only scratched the surface. This similar debt product exists in corporate debt. It exists in municipal debt. It exists in state debt. I mean, just all over the place. There are these debt products of issuing bonds. And I've always known that that's out there. So I plan to be digging in a little bit more to that because, when we got to the bankruptcy of First Republic Bank that Viper and I were both kind of involved in, at least because we held equity, one of the things when it comes to the bankruptcy of a company and all that stuff is the bondholders of that corporate debt actually have claim to the money that is left in a company and things like that. So, while this is nowhere near as stable as treasuries, which is why I started with treasuries, learn about them, the same principle and concepts exist in the private market of private companies issuing debt to pay for things, for cities issuing debt to pay for basically just like the federal government is issuing debt to run itself. Your local municipalities are issuing debt to run themselves. Your local state governments issue debt to run themselves. And it's just a different aspect of really looking into this fixed income and debt investment that I definitely will be learning more about. So hopefully we got something going for you in terms of thinking. Otherwise, maybe next week's episode we'll pick you back up again. Lot happening in the market. Really big pullback lately, big slide. Talk around interest rates and the cost of debt. Kind of all tangentially related to this topic. Really, I'm excited because volatility is finally coming back, and I've really missed my friend volatility. It's been too quiet for too long. So I'm super excited that there's some action happening and volatility really coming back. Hope you guys are finding what you're interested in trading in. I hope you can find some things, and we'll talk to you next week. Remember, think outside the block.